Okay, um, so we are talking about um, internal controls over cash. And the most basic and fundamental internal control over cash is typically it's monthly reconciliation of the bank statement. All right. Um, Now the reality is that the bank statement is um, well. Let's actually start with the importance of bank reconciliations. All right. So these documents are so important that oftentimes as an auditor, these were the first things we would ask for. And we'd have the clients send over the bank reconciliations before we even showed up at the client site to do test work. All right. Um, and also, this is something you want to be familiar with because as it turns out, um, it's not just accountants who do these. In any organization, oftentimes if you have responsibility for a bank account, if your department has a bank account, then your department also is responsible for reconciling that. All right. Oftentimes I would see, um, non-accountants who had the responsibility of reconciling the bank statement. Okay. Now let's talk about the banking institution and what bankings do. So on this particular slide, we see um, bank services. Okay, so here's just some of the things. Checks, for instance. Well, what is a check? It's permission for your bank to pay money on your behalf. All right, very similar as an electronic funds transfer. Same premise as a check. It's submitting payment. It's just done electronically. All right. Um, Other bank features that are important. So basically, having a bank statement is like six or seven different internal controls kind of rolled into one. But the one we're going to focus on for the next few moments is the bank statement. Right? You get bank statements monthly, usually, from a bank, and these can either be in the mail or more frequently. If you have a bank account, you know banks are trying to avoid the cost of mailing and printing these, so they would like to email them to you. Uh, it doesn't really matter whether it's mailed or emailed. The result is the same statement. All right. And so here's an example of a statement. Yours may not look like this, but it has the same information. It's basically a roll forward. All right. So you'll have the previous balance or your beginning balance, uh, checks and debits, which means those are withdrawals, deposits and credits, and an ending balance. Right. Those are the basic parameters of a statement. Usually there's a date. And then you have the detail, right? So if we were to add all these amounts up, they should add to $723. Those are the withdrawals from the account. Same for deposits and credits. All right. So the reality with bank statements is that the banks are keeping track of transactions in the account, and also the accounting department should be keeping track of transactions in that cash account as well. And so there is a possibility that there could be differences. In fact, there most likely will be differences between the balance that the bank statement has at the end of the month and the balance in the accounting records or the company's books. All right. So the reconciliation is done in two phases. And here's a basic skeleton reconciliation. The first phase starts with the bank balance, which would be the ending balance from the bank statement. And then you add there's additions or deductions, and we'll get into the detail of these. But once you add or subtract certain things that aren't reflected on the statement, we get to an adjusted bank balance, right? And that's the first phase. The second phase starts with the book balance, which is from the accounting records. And there's a good chance there's going to be some things on the statement that the accountants haven't yet recorded. All right. So we add or deduct those things, and you end up with an adjusted balance. Now, if you've done this right, the adjusted bank balance will equal the adjusted book balance. When they do, you've reconciled the account. If they don't, you're not done with the reconciliation. Okay, so we referenced the additions and deductions from the book balance or the bank balance. Here are some common additions or deductions. All right, deposits in transit. Well, that could be one of two things. If the bank statement ends on the last day of the month, it ends when the bank closes. So if the bank closes at 4 or 5 p.m., then that statement is going to be accurate as of that day. Well, if you're in retail, retailers are open later than banks, and if you send a deposit or use the bank night drop, that deposit's not going to be credited until the next banking day. All right, and that's the example of a deposit in transit. The other example that I can think of is a deposit. So let's say your receivables department receives some checks and it submits them to the bank either via mail, FedEx, or electronically, and they haven't yet been credited to the bank account. Those would also be classified as deposits in transit. All right. Outstanding checks. All right. So when a company writes checks, and oftentimes they'll put them in the mail, all right, the checks would be received, and if they're not immediately cashed, those are outstanding checks. So those are checks that the company's written, and as they were written, they would have reduced the company's book balance, but the bank hasn't yet received those for payment. So the bank, they're not reflected in the bank balance. So we'll back those out. All right. We'll come back to errors in a moment. All right. Adjustments to the book balance, cash collections and interest. All right. Certain things like notes receivable are actually collected by the bank. You may recall notes from the previous chapter. All right. And so when the bank makes those collections, they're going to include it in the bank statement balance, but it may not necessarily be reflected in the accounting records. All right, so we'll make that adjustment. Uncollectible items. These are bounce checks. So when a customer writes a check that doesn't clear, well, you've already recorded it in the balance per books, or the book statement balance, because that's what internal controls dictates, that you increase the cash balance when you deposit a check. Well, some bounce, and you have to back that back out. All right. Errors. This is kind of the wild card, because you really need to kind of look and analyze at an error, determining whether it's a bank error or an error from the company's accountants, and that's how we determine where that goes. All right. One thing to keep in mind: every adjustment to the cash balance per book requires a journal entry. All right, because those represent transactions that haven't yet been recorded in the accounting records. All right, we're going to work through this. This is abstract, I know. I'm going to post an exercise working through this so you can see how this looks in application. Okay,